Good morning. It's Wednesday, the 23rd of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take, that sinking feeling. The stock price of L&T Finance fell to a 4-month low after HSBC Global Research cut its target price on that stock. The reason given, according to a report in NDTV Profit, was a likely disruption in assets under management and earnings per share growth in the near term because of sectoral headwinds in microfinance. Now, that is obviously a segment or a sub-segment of finance. But L&T Finance is not alone. Bajaj Finance, the better-known one, reported lower than expected second quarter profits on Tuesday as it set aside more funds for potential bad loans. The company reported consolidated profit after tax of about 4,000 crores in the 3 months to September 30th, but analysts had expected more at about 4,300 crores, according to estimates compiled by LSEG and reported by Reuters. Bajaj Finance has been grappling with elevated losses in the last few quarters, especially in the personal segment in rural regions, as well, adding that it had also reported lower than expected profits in the first quarter, hurt once again by higher funds set aside to cover potential bad loans. Now, several NBFCs have already been asked to stop lending, including in the most recent crackdown last week by the Reserve Bank, which included a few app-based ones for, among other things, usurious lending or unlawful interest rates, coupled with, of course, poor due diligence and a whole set of other problems. Now, it is no secret that the Reserve Bank of India has been consistently warning about excessive lending in unsecured loans and small loans. Now, the more aggregate data in terms of impact on banks or non-bank finance companies will emerge in coming days. But it is clear that there was froth at the top when it comes to consumption and demand, whether for products or for services, and driving speculative activity in the stock markets. And this froth has been driven by borrowing and not real income. The extent of this may be limited and might not cause systemic damage because the controls at the top are fairly strong and the Reserve Bank of India has been steadily tightening norms, including asking for more risk weights on the lenders' balance sheets as it did in November last year. But the unwinding can be painful, mostly for those who borrowed and recklessly consumed. Markets could slip further and more small loans could go bad. This would also raise some questions on the nature and quality of that increased consumption in the first place. A good part of the post-COVID spike in spending was partly driven by borrowings. This is not so much the problem as the resultant interpretations of the quality of spending and the resultant consumer spend data. It would appear to me that companies have overinterpreted consumer spending behavior to some extent and are sounding now somewhat surprised as it is moderating. There is that sinking feeling which will stay till we are able to see the full picture on what really happened in the last 3 years, particularly on the balance sheets of non-bank finance companies, among others. And then worse, the individual balance sheets, which we may never see. And that brings us to the top stories and themes of the day. The stock markets fall sharply as the Hyundai Mega IPO fails to impress. A quick look at cement and information technology sectors and what's driving things up or down. HSBC Restructures to get its first woman CFO or Chief Financial Officer. And China Plus One has fallen short when it comes to India, with countries like Vietnam benefiting more.
This is the Core Report with Govindraj Ethiraj.
The stock markets fall 930 points. I can't say my worst fears have come true, but some fears clearly have. The stock markets fell as India's largest initial public offer or IPO till date listed on the stock exchanges today. Before we get to that, the indices saw their biggest single-day drop in about 3 weeks on Tuesday, thanks to slowing corporate earnings and continued foreign selling, which appears to have crossed $11 billion for the month of October now. Interestingly, the markets opened in the positive on Tuesday and stayed so for the first hour of trade before slamming the reverse gear, logging their worst session since October 3rd. All 13 major sectoral indices declined and 47 of the Nifty 50 stocks logged losses, says Reuters. Hyundai's mega, almost 28,000 crore IPO listed today at a discount and generally took the rest of the market down after that, as some of us were wishing it would not. This is not to say that there is a direct correlation between mega IPO listings and market falls, but it does happen, and it has happened again. Hyundai Motor shares fell about 7.2% on their market debut on Tuesday. The stock listed at about 1,934. That's below its offer price of 1,960 and finally closed at about 1,819. All of this valued the company at about 148,000 crore rupees or about $18 billion. The Sensex fell 930 points to settle at 80,220. The NSE closed down 309 points to end at 24,472. The Business Standard said that the stocks that were lost were Bharat Electronics, Mahindra & Mahindra, Adani Enterprises, Coal India and State Bank of India, whose losses were close to 3.8% or almost 4%, adding that only ICICI, Nestle, and Infosys were somewhat positive. The Nifty small cap index was down close to 4%. The Nifty mid cap was down about 2.5%. The fear index, or the India VIX, which gauges volatility in the stock markets, has ended higher by 4.2% at 14.34. The last time we were talking about VIX was somewhere just after the election results. The Nifty PSU Bank Index was the worst hit amongst the sectors, was down by about 4.18%. F&O, a national pastime. Although India leads the world in futures and options trading volumes, it's a crown that the Securities and Exchange Board of India does not aspire to hold, given that 93% of retail investors experienced losses in this market segment, according to whole-time member Ashwani Bhatia, quoted by NDTV Profit. He was speaking at a Morningstar Investors Conference and stressed on the importance of protecting retail savings and discouraged the perception of F&O trading as a national pastime. The Securities and Exchange Board of India has, of course, and as we've reported, put forth a series of new regulations aimed at curtailing activity in the derivatives segment, including stricter margin requirements, larger contract sizes, and enhanced upfront premium collections, as well as clearer risk disclosures for retail investors. Like we discussed earlier, or just earlier, the issue is not just the fact that 93% of investors are losing money, it's about where they're sourcing the funds that they are eventually losing. Speaking about losing, the Indian rupee slipped to an all-time low on Tuesday, pressured by weakness in its regional peers and likely outflows from local equities. Though the Reserve Bank's intervention helped curb sharp declines, according to Reuters, the rupee closed marginally weaker at 84 rupees 07 paise against the dollar, its weakest closing on record after touching an all-time low of 84 rupees 8 paise earlier in the session. Asian currencies also fell, and the dollar index was at about 103.9, which is its highest level in 2 months. As we mentioned yesterday as well, the rising odds of a second presidential term for Donald Trump have boosted the dollar and US bond yields in recent sessions. The equity markets too have risen to some extent on this regard. Meanwhile, back home, or rather at home, the International Monetary Fund on Tuesday kept its growth forecast for India unchanged at 7% for 24-25 and 6.5% for 25-26, saying that pent-up demand accumulated during the pandemic has been exhausted as the economy reconnects with its potential growth, which I think is another way of saying that it's going back to some level earlier. The IMF said in its latest World Economic Outlook report that in India, the outlook is for GDP growth to moderate from 8.2% in 2023 to 7% in 24 and 6.5% in 25 because pent-up demand has been exhausted. A closer look at information technology and cement. Now, non-bank finance companies already facing sectoral headwinds. Where do sectors like cement and IT stand? Let's pick on cement first. Despite the general bullishness on infrastructure and housing demand, the last few months have been bad enough to send cement prices down to a 5-year low. While demand might pick up in the second half of the year and thus make up to some extent, there is a problem of overcapacity as well. So overcapacity and low prices, not something that's been highlighted very clearly in the last few months, at least in my conversation, and yet here it is. The Mint newspaper says pent-up cement demand is expected to drive volumes, but supply is also set to rise. In the next 2 years, industry-wide capacity addition of about 30 million tons per annum is expected, of which about 50% would be run by Ultratech, the Birla Group company, which saw a 36% drop in net profits in the last quarter. Elsewhere, the Adani Group company Ambuja Cement announced an acquisition of a 47% stake in Orient Cement. Also on Tuesday, cement is a very regional business, and majors like Ambuja in this case and Ultratech earlier have been buying capacity in different parts of the country. I spoke with Divyam Mour, research analyst at Samco Securities and cement analyst, and asked him why prices had hit such lows.
So if you see the cement sector, it is facing a muted demand. It has grown about 2 to 3% in the first quarter. And historically, if you see construction activity slowed down due to monsoon, so it has an effect on the cement demand. And if you see on the supply side, the top 4 cement producing companies, they are increasing their capacity. They are expected to increase around 42 to 43 million capacity in this year. So this additional capacity is creating the disparity between the demand and supply. It is putting extra pressure on the downward pressure on the prices. And if you see coal, pet coal and diesel, in the 7 months of financial year 25, it had lowered down. So coal had reduced by 34%, pet coal has by 15%, and diesel by 2%. And the companies are passing on this reducing cost to their customer. So this is also additionally leading to the reduction in the cement price. So it has lowered down to the level of 2019.
Got it. So at this level, do you feel that the next couple of quarters are going to be very tight for all cement companies?
As I said, quarter one was primarily down due to the general elections. It faced muted demand, and quarter two is historically down. But if you see quarter three and quarter four will come back on its track. The infrastructure theme, it is still in focus. It is still in line. And the housing structure demand, it is going to boost the cement sector demand. So the demand will be there. And on the supply side, the cement producing companies are in line to meet the demand. They plan to extend their capacity. So if you see on the demand and supply side, the cement sector will grow. Some irregular events might happen in the short term, but the overall sector is good. Overall demand outlook is
So
good.
you're not seeing an oversupply overhang.
In terms of quarter one and quarter two, there was oversupply. That led to the downward pressure. But if you're asking for the outlook of quarter three and quarter four, the demand will increase.
And you're saying overall demand is more or less on track. I mean, though if it was lower for the last two quarters,
Yeah. The quarter three and quarter four demand will get a rise.
how would that be compared to last year, same time?
So if you see in the financial year 25, it is expected to grow at a rate of 7 to 8%. Ultratech 2 is expecting it to grow at a rate of 8%, the demand. So in the first quarter, it was about 2 to 3%, but if the remaining half year, it is going to grow by 10 to 12% to be on the track of the 7 and 8% expected for the year.
So you're saying very broadly the cement industry is doing well then. I mean, doing well in the sense at least, or second half will make up for the first half. And you're not really seeing any demand slowdown as such beyond what happened in the first half.
If you see the Pradhan Mantri Awas Yojana, 10 lakh crore was allotted to 1 crore housing for the middle class and the urban. So that will help the demand because government is still doing its bit to increase the infrastructure and all the plans are in there. It has not been substituted yet. So the demand will be there.
Is there anything else that you're taking away from the fact that prices are so low?
No, sir. The primary factor I told you was that the extreme supply, oversupply led to the prices and the reduction in the input cost. Because the competition is such that they are passing on input cost to their customers so that they keep with the customers.
Divyam, thank you so much for joining me.
Thank you, sir.
And then there is IT services. Results have been a mixed bag with some IT majors like HCL Tech reporting better numbers. What are the trends telling us though? Remember, both TCS and Infosys have stepped up hiring, which in itself could be a positive sign. Could there be other signs, whether positive or not? I spoke with Sagar Shetty, research analyst at StoxBox, for some quick takes.
If we consider the US election, which is going to happen in November, so that is one of the factors which could delay during the third quarter as well, like because of the deportation rules or anything like that. But other than that, after the calendar year comes in and after the budgets are posted in by the company, we feel like the company are really going to do well, and especially the tier one companies because of the wide variety of services which they can provide. So companies like TCS, Infosys, and HCL grow through the quarters and going ahead with. And one more factor also to consider is the deferment in the ramp up deals which are happening in the previous quarters, which could not be followed which are not going to be happening in the coming quarters as well because the discretionary spending are expected to pick up. So yeah, so the pipelines are expected to be robust. The deals are expected to be coming in as fast as they can, and the attrition rate is also expected to be lower in the coming quarters as well.
Sagar, thank you so much for joining me.
Yeah, thank you. Bye.
China plus one has fallen short. India's attempts at boosting its manufacturing sector by capitalizing on the US-China trade war, or China plus one as we've been calling it, have fallen short according to a new study with other Asian rivals benefiting to a much greater extent from these tensions, the Business Standard reported. Between 2017 and 23, India's total share in US imports rose by about 0.6% points to 2.7%, while mainland China's portion dipped by about 8% to under 14% according to Oxford Economics. So the biggest beneficiary from this trade diversion in the region has been Vietnam, whose total share in US imports grew 1.7 percentage points to 3.7% in this period. Taiwan and South Korea have also benefited, increasing their share of US imports by 1% point and 0.7 percentage points according to Oxford. The research also implies, as we've been discussing here at the core report, that India may face headwinds if Donald Trump returns as US president and follows through with a threat to impose a 60% tariff on Chinese goods. Alexandra Herman, the economist at Oxford Economics, wrote that the US-China trade war so far has improved India's export prospects only to a limited extent, dashing hopes that an escalation of the conflict could boost the lagging manufacturing sector. And India's export strengths largely lie in sectors of the old economy where growth potential is limited and competition is fierce. Overall, in areas like electronics, India's imports from China have risen dramatically. Contrary to the perception that it was going down, India's exports of electronics have also gone up, particularly with companies like Apple. HSBC restructures globally. HSBC globally has restructured and named Pam Kaur as Chief Financial Officer and announced plans to revamp its regional operations around the world. Taken together, the changes mean that HSBC, which has a large India presence, is embarking on its biggest restructuring in at least a decade, according to Bloomberg. The changes will cut the number of executives who sit on the newly named Key Operating Committee to 12 from 18. With Kaur as Chief Financial Officer, she's the first female finance officer in its 159-year history. She joined in 2013 as audit head before overseeing risk and compliance, according to Bloomberg. As part of the new geographic setup, HSBC will have an Eastern regional unit, including Asia Pacific and the Middle East, and a Western market that includes its non-ring-fenced bank in the United Kingdom, Europe, and the Americas. It has also made Hong Kong and the UK standalone units. Last year, it eliminated roles held by 3 regional chiefs who oversaw operations in about 160 countries around the world, with legions of managers with that same geographic focus. And those changes are part of what's allowing the firm to cut more than 20,000 jobs across the company, said Bloomberg. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.